Fed meeting and big tech earnings on deck, nearly 40% of the S&P 500 reporting. Let's bring in Samana of Wells Fargo Investment Institute and our own senior markets commentator, Mike Santoli. Guys, welcome. Samir, what's the impact, true impact, longer term, of this trade deal with the EU as it affects certainty or lack thereof? Is 15% a damper on growth, or is the certainty a bigger positive impact?
Yeah, I mean, look, I think in the short run, it's kind of addition by subtraction, right? Which is, it basically takes a negative surprise or a headwind kind of away from the markets. I would imagine after the European deal, and then let's see if, they can kind of kick the can on the China thing for another 90 days. If you get those two pieces to fall into place, we probably stop talking about trade for a little while. Now, the part where I think we will focus is, all right, who pays these tariffs? And if you kind of look at, whether it's exporters outside the U.S., U.S. companies and U.S. consumers, I would imagine U.S. consumers probably end up feeling the brunt of it. And so we would imagine that the U.S. economy probably slows in the remainder of the year. And it'll be interesting to see how the market kind of deals with that.
Okay, Mike Santoli, talk me through a couple different scenarios here. One for the people who either rode the S&P up this far, didn't sell or get scared in April. Those people are probably feeling pretty smart. Maybe they're even doing some risky stuff on the side, which has been doing well also. And then there's a group of people who are not feeling so good because maybe they did get scared or they went conservative into this period and they're feeling like they want to catch up. What should those two groups of people know about markets at highs where we are now?
Well, as a general matter, John, I mean, when markets are reaching new highs, it sounds counterintuitive, but the forward-looking implications of that are more net positive than not. In other words, it's more of a sign of strength begetting strength eventually or over longer periods of time. I would say that I think you have to acknowledge, if you're in this market and you're looking at valuations and you're looking at the reactions to news, that the market has priced in a pretty positive scenario right here. We may get that positive scenario. You might even get better than what's already priced in. But in general, whether you're looking at the sustainability of the AI-driven revenues and profits on one side, or this kind of benign, kind of steady-as-she-goes economy that you're going to get rate cuts down the road and trade's not going to interfere too much with friction from tariffs, I think that's where we are. And so I think you have to just adjust your expectations accordingly if you're in the market. If you're not in the market, you're not buying it cheap right now. I do think you have to, kind of understand that. But it also is, markets can really go a lot farther than you think is likely when you're just kind of anchoring to a certain recent low, right? I was just looking at the S&P 500 is up like 12% from the day of the Liberation Day announcement. And that's when we thought we were already pricing in like a 15% blended tariff scenario. So clearly things have broken for the positive, and it's hard to know when that stops being the case. We're not at max valuations. I think the NASDAQ 100 is at like 28 times forward earnings. It's traded to 30 back in the pandemic, but not much above that in the last 25 years.
Samir, to Mike Santoli's point, fear-based investing has worked especially poorly, it seems to me, over the past decade. Aside from maybe a couple of years here and there where people felt good backing away from the market, there have been a lot of times when people have said, oh, well, this market is historically expensive, but it's continued to go up. So what does discipline look like in a market like this? What should people do versus don't do?
Yeah, it's a great question. And in some ways, it's the only question, right? I think the right thing to do is stay invested, especially in those areas that have secular drivers that have nothing to do with trade, right? So I would point back to AI. We like U.S. large cap equities. We like tech. We like comm services. Some of that financing comes from financials. We like utilities. That's where a lot of the power generation comes from. None of those areas really have as much to do with trade and tariffs as some of these other areas that we don't like small caps, emerging market equities, consumer discretionary, right? That's where you're going to figure out, who pays the tariffs. So I think that's what you do is you focus on the secular drivers when you have kind of these smoke screens thrown up. But then I think bigger picture, you also look at the fact that bonds are still pretty expensive, right? I mean, when you think about the after-tax, after-inflation yield on the 10-year still sits, close to zero, equities aren't all that bad on a relative basis, especially those areas that I mentioned.